Hi, I'm James Ledbetter. I'm the executive editor of The Observer and also the editor and publisher of Fin, which is a Substack newsletter about the fintech industry. Please find it and subscribe. Very pleased and honored today to be moderating this esteemed panel about financing product-led growth companies, and very pleased to be joined by three very knowledgeable guests. I'll introduce them by alphabetical order. We have Ryan Koonce, the CEO of Mammoth Growth, Kyle Poyar, who is a partner at OpenView, and Blair Silverberg, the CEO of Hum Capital and a former VC at Draper Fisher Jurvetson. Gentlemen, welcome. We are going to talk today, as advertised, about product-led growth. What is it? Do you want it? How badly do you want it? What will you do to get it? I think everybody will agree that this is a particularly important topic given the interesting state of the equity markets right now. We'll also be comparing and contrasting product-led growth with sales-led growth. There's a school of thought that says that Google ad spending not only gives a greater ROI than, say, the next feature sprint, but also is easier to measure. Is that true? Can we have both? Just as a reminder, we would love to have questions from the audience. You can drop them in the chat. Don't feel the need to wait until the end of the webinar. If you've got something you want to say, put it in the chat, and if it's a good question, we'll find a way to weave the conversation. So let's get started. I want to start with the question: what is product-led growth? Kyle, why don't we start with you? Tell us what you do at OpenView, how you define product-led growth, and how you talk to your portfolio companies about implementing it.
Absolutely. So, hi folks, I'm Kyle. I'm an operating partner at OpenView, which means I get to spend my time working with entrepreneurs in our portfolio around strategies to drive faster revenue growth and hopefully dominate their markets. Previously, I was at Simon Kucher, the largest consulting firm working on pricing and packaging. And I joined OpenView in 2016, the year the firm actually coined the term product-led growth. It's become kind of a household term in software since then. It certainly didn't start that way. The way we think about it is that product-led growth is when the product is a core driver of how you attract, convert, and expand your customers. And it's not, like an on or off switch. It's more of a dimmer switch. So just about any software company in my mind can add elements of product-led growth to build a more efficient business by essentially taking things that would maybe be done manually or in a very resource-intensive way and build product solutions that offer a more consistent customer experience, hopefully a better customer experience that can scale independent of adding bodies, and ultimately is a win-win for you and your customers. And we can talk a lot about the different aspects of PLG, but a key element in my mind is that you're reorienting from thinking about growth is coming from your sales and marketing investments. So metrics like CAC payback actually don't really matter in a PLG model because you're using product investments as a revenue generating expense rather than just sales and marketing investments.
Got it. So that's a great definition and raises a couple of questions. One is, can you give us, I think it's just easier for people to understand if they have some examples. What are some of the classic examples of a successful, well-known PLG company?
Absolutely. Well, in our portfolio, you can't really get much more classic than Calendly. Many folks probably use Calendly, have seen a Calendly link sent your way. So I think the first thing is that Calendly was built for users rather than just executive buyers. So that the user frustration of going back and forth to schedule a meeting is something that millions and millions of people experience. And so they built a product that solves a problem that everyone faces. Folks can set up their Calendly account really easily. They just connect their cloud-based email, usually Gmail or Outlook, and then they can just start sending it to folks and scheduling away. And then the product actually exposes other people to Calendly. So a lot of the way that Calendly generates new users is that folks come across the Calendly link from someone else. They realize how much easier it is to schedule that way, and they sign up for their own account. Maybe they decide to pay, maybe not. Either way, it actually works great for Calendly. And then eventually, there's generally multiple folks inside of an organization who are using Calendly. So maybe multiple sales folks, or maybe a salesperson and a customer success person. You start to want to do round robin scheduling or scheduling with multiple people, and that end user, maybe becomes a team account or an organization-wide account. And there's some interesting things Calendly does to accelerate from that bottom-up adoption. But the starting point is the user and a product experience.
Got it. Another example that I always think of when I think about product-led growth is Slack. When I was the editor-in-chief of Inc. magazine, we named Slack Company of the Year. I think it was 2015, and we had a chart in there that showed month-by-month growth, and it was just phenomenal. I mean, you couldn't even imagine something growing like this, and it was all word of mouth through engineers, and to your point, somebody in the organization is using it and say, hey, look at this. No sales apparatus whatsoever.
To that point, real quick, you can't grow as fast as Slack did in the early days with a traditional sales team.
Right.
That's right.
It takes too long to hire folks, find the right people, get them vetted, get them brought in the organization, make them productive, and then onboard all of those folks. If Slack had a sales heavy model, it would have been very bloated, much more expensive for them to build, and just naturally couldn't grow as fast.
Yeah, and even if you could, it would be so much more expensive. But that also raises one more question, and then I'll get to the other speakers, and that is, well, how do you make money if you're not focused on sales? Is it a freemium model? How do product-led companies create revenue?
Well, and they end up being very good at creating revenue, especially standout folks. When you look at companies going public, the majority of them these days have an element of product-led growth. The way I think about it is, you start off attracting a kind of wide net of potential users, focus on organic channels like search engine optimization, word of mouth, community, focus growth, partner growth. And then folks start to use the product. So you measure their product engagement. You ultimately convert folks initially, usually via self-service. So folks can put in a credit card and buy at a small dollar amount. And then you earn the trust of that organization, where that initial user starts to invite their team or starts to call on the product for more more sophisticated use cases inside of an organization. Many PLG companies will have usage-based pricing as well. So if you think about like a Twilio or a Datadog, the more the product is consumed, the more the customer pays. And so what you tend to find is that revenue growth is maybe slower early on, because you start with a lot of users and not a whole lot of revenue, but it ends up working like compound interest, in that expansion is faster in product-led accounts, and the overall model looks really repeatable at scale.
Great. Yeah, I'll date myself, but a guy called Halsey Minor said to me in the 90s, you just build the eyeballs, you'll figure out how to monetize them later. Ryan, what about you? What have been your experiences with product-led growth, and what do companies and founders typically have to learn in order to master the strategy?
Yeah, definitely. Thanks. Well, look, at Mammoth Growth, we're principally involved in helping companies measure the different aspects of their system so that they can optimize that product-led growth strategy. I mean, in talking about, both Calendly and Slack in particular, they just innovated on the onboarding process in a way that, nobody had done before. And I remember signing up for, Slack the first time and just thinking, man, this is ingenious. This is just the slickest thing I've ever seen. I mean, I was taking screenshots. I was just like, completely blown away, by that onboarding process. And so, at Mammoth, our principal focus is thinking about, well, great, we've got a product and the product is good, but how do we optimize it so that there's two things can happen? One is, the first part is, to Kyle's point, how does the company get other people involved in the product, tangentially. What's the mechanism for the invite? How are we going to measure that? And then how are we going to turn that response rate into something that we can optimize? And then on the same note, it's also, how do you monetize? So we have all these people that have been brought into the system, and we want to generate more revenue from more customers more often at lower cost, right? That's just business. And so in the context of PLG, at Mammoth Growth, it's really about identifying those metrics or answering those business questions that are going to drive yield, making sure that we can measure them appropriately, and then doing sort of thoughtful testing and optimization programs that move the needle, right? And you want to focus on, in a product-led growth strategy, you can measure everything, but it's really about what is the thing we're going to do in the product or test in the product that will drive the most yield most quickly. And so those would be the areas that we would lean into.
Got it. Blair, let me ask you the question that I think has occurred to everybody, and that is, are these strategies, product versus sales, are they mutually exclusive? Can you do both? Should you want to do both? Or does it vary from company to company?
Yeah, they're not mutually exclusive. You should seek out compound interest wherever you can find it, because it compounds. But I think the biggest challenge with product-led growth as a growth strategy is getting it financed, because investors, in the most simplistic sense, they understand like inputs and outputs. So like if I have a widget business and I spend $100 on ads and I sell $200 of widgets, that feels like a good return. I got a 2x on my ad spend. It's an immediate return, so I can see it in the company's metrics. And I don't need a guy like Ryan to help me really figure this out. Like I can track it in the spreadsheet.
You do, because most people can't count that well, but
I think that is completely true. But as your growth tactics become more sophisticated and more complex, they become much more difficult to attribute what's going on and ultimately communicate to investors, hey, I'm a good steward of capital. I can take one of your dollars and invest it. And although it's going to sound like I'm doing something that's building out a product feature, this is going to become a really efficient growth tactic. Doing that math and telling that story in a very clear way is the difference between raising a bunch of money to finance the further growth of your PLG company and not. And I think that what's really interesting from my perspective is the math is not impossible to do. We'll talk today about how to do it. But organizing the company data and getting it to a place where you can really do this math in a sophisticated way. I mean, this is why what Ryan does is so important, and so important to get right in a company early on. And then also thinking, to your point about how you balance multiple strategies. Do you do PLG only? Do you do PLG in sales? If you do PLG, where do you do it in the funnel? There's a whole canvas of possible options, and getting those right, sequencing them right, is really, really important.
Yeah. On that note, there's a question from the audience. What's the denominator when measuring ROI and effectiveness of product-led growth if it's not CAC? What are the things that you look at that are different than if you were looking at a sales growth model?
Well, some of the things that I look at personally are burn productivity. So how much net new ARR are you adding relative to your burn rate? And that's thinking about your business holistically across your R&D spend and sales and marketing spend. Other things I look at, I do look at the ratio of R&D spend versus sales and marketing spend as a way to see if you are, in the right ballpark relative to benchmark. So how much are you spending on R&D as a percentage of revenue and a relative basis to sales and marketing? The typical
is it better for that ratio to be high or low?
You want the ratio to not, you don't want to be spending 100% of your revenue on your R&D. That's just not going to be a productive model. But you want it somewhere like, hey, we're spending 40% of revenue on R&D, maybe 20% of revenue on sales and marketing, whereas the typical software company is reversed, and maybe even spends more money on sales and marketing than 40% of revenue. Maybe it's more like 60, 70, 80%. So looking at the benchmarks of your spend versus peers is helpful. The third thing I would look at is when we look at our portfolio companies, there's a natural sort of element of growth that comes through this product-led motion where people sign up, they maybe convert via self-service, they find the product through word of mouth or organic search, and there's normally some sort of natural rate of growth or kind of underlying business that you don't actually need to spend a whole lot more in order to grow. And then companies look at things that are experimental. So maybe it's experimental product bets, experimental sales hires, experimental marketing campaigns. I would try to evaluate the ROI of anything that you're doing incremental as essentially a series of bets that you're hoping is going to pay off and should have an expected return profile. And you should be looking at that both for sprints that you run on the engineering side, as well as the marketing and sales efforts that you might be doing.
That's really interesting, and I want to come back to some of these analytics questions. And this is a question for all three of you. Most of what you're describing took place in some now distant seeming moment when tech was shooting through the roof. A lot of tech companies were going public or being acquired. VCs were throwing, tens of billions of dollars per quarter or more at these companies. That for the moment has gone away. So does that mean that the model needs to evolve? Do you change your advice that you give to portfolio companies today and have them do something different in terms of PLG, or is it just sort of steady as it goes? The plan is the plan. It's a good plan. Follow the plan. Anybody can take it.
Well, I think the biggest challenge when equity becomes more expensive and the market contracts is investors are looking for return on their investment in a shorter time frame. And so one really interesting thing we've seen from Hum's perspective is, we're doing a lot of private credit. Private credit's actually grown in its appetite for companies, for risk, even the terms getting more flexible and aggressive despite this market contraction. And the reason for that is that a lot of private credit investments are looking very granularly at things like, I'm factoring receivables, so I'm buying up front a bunch of bills that you've sent out to your customers, or I'm financing the business at a multiple to ARR that is way more conservative. I mean, this is really interesting. A lot of people don't know this, but businesses can get up to 3 times ARR in credit capital. So if you're a $10 million ARR business, you could raise a $30 million credit facility on your ARR. But last year, a lot of companies were raising equity at 100 times ARR. So as a lender, you're still like 97% more conservative than the equity investors. But to make a long story short, a lot of these calculations are very granularly tied to some financial asset, whether it's receivables or the efficiency of sales and marketing or so on and so forth. And so that calculation doesn't change much ever. It's kind of a fundamentally base calculation on the economics of a business. What changes a lot is the expectations for the future, and that impacts equity quite a bit. And so that's how you can get the Bessemer index, top quartile going from whatever it was, 40 times ARR to like 12 now. That's just a little shift in interest rate expectations for the future. Hey, maybe this COVID thing isn't actually as much of a secular trend as we were all telling ourselves in 2020, can have a massive and magnified impact. And what that does from a PLG perspective is it makes it more expensive to finance PLG bets unless you can make them feel to an investor like they're as clear and attributable as spending my $100 on widget ads and selling my $200 of widgets. And that calculation you can do. Guys like Ryan help you do it, but it's like way more critical now than ever to be able to do that really clear attribution and tell that story, because the markets are a lot less aggressive and sort of give you much less of the benefit of the doubt than they would have a year ago.
Ryan,
yes, I guess just to follow up there, my take is that your advice there kind of applies to any company, regardless of whether they're PLG. So any company, when capital is more scarce, valuation expectations are lower, appetite for high burn profiles just isn't what it used to be. It's imperative that startups protect the core and double down on what's working, and they just naturally are going to not be able to spend as much on experimental bets that are unproven and seen as expensive and hard to necessarily justify. And so if you are a PLG company looking at doing things like adding a sales team or going outbound for the first time, that's going to be seen as experimental and unproven. But if you're a traditional sales-led company looking at adding a PLG motion, it's going to be the same story. So I think it's more around this idea of, hey, let's double down on the core business right now and strip out anything that's extraneous.
It's interesting, Ryan. I'm curious to hear your perspective. I mean, obviously, I take at face value what Blair says. I thought the conventional wisdom in the current environment is that a lot of companies, there's pressure on them to move away from growth for growth's sake and toward profitability. And maybe those things are not mutually exclusive, but they're often portrayed as such. But I'm curious to know your experience in the current environment.
Well, I think it starts with companies having to be more rigorous about the way that they're measuring things that maybe they weren't before. So, hey, we're growing for growth's sake and we're growing, so who cares? It doesn't matter what our return is because we added 100,000 new users. I think, that mentality from our perspective has always been relatively flawed because you could have avoided a lot of, mistakes along the road if you had known that, 80% of those users were costing you twice as much than you'll ever make, right? And so, we always believe that rigor is an important piece of the analytics equation. And again, it's all about prioritization. So what are the things that we're really going to look at and which pieces of the puzzle are the most important? That's something that companies struggle with. And so, from a financial perspective, and to Blair's point, they're seeing companies that by definition know exactly what their ARR is and what their customers look like and what the payback period is. And that's how they're going to finance those transactions. So we see the company before they can even show up for that conversation, where it's, I have revenue in Salesforce and Stripe and PayPal, and I don't know exactly whether it's an account or a user, right? So if you think about PLG, where you're adding individual users that are parts of accounts, you'd be shocked how bad companies are at tying users to accounts, as an example. So there's simple things like that, where in a contracting equity market become table stakes. You have to be good at them, and you tend to into.
Yeah, I'm glad you said that. That sort of leads into what I think is the next thing that we should dive into, and that is data. What are the data that PLG companies generate? How are they different from the data that other companies generate, and what are the sources of the data? Blair, do you want to tackle that?
Oh, this is a better question for Ryan, I think.
Ryan,
I would I would love to hear what Blair thinks is important for data from a financing perspective, and same thing from Kyle.
Yeah, I mean,
because I think that there's
but yeah.
And the reason is, we view every company as a bespoke project, where ultimately it's more revenue for more customers more often at lower cost. But that can be split up into an infinite number of opportunities for product or testing optimization. And our use case is going to be, for somebody like Blair or Kyle, like, hey, I want to go raise money. I want to optimize something. I have a consumer of this data, which may just be the CEO or the board. And so, I'd love to hear what you guys think, and then I can layer on top of it what we're seeing across our portfolio of clients.
Let's try this in. I'll give a top-down picture, and then Kyle, maybe give more of a bottoms-up kind of as a practitioner picture. But if you go top-down as an investor, all businesses are the same at some level. All businesses have revenue, they have expenses, they have profit, and then they have different lines like gross margin, which is sort of like, profit from selling products and services before you pay for the team to run this whole business, and so on and so forth. So what you're looking to do as an investor is you're really just trying to compare businesses across as many spaces as possible to pick the best ones who are using your capital the most efficiently. And so if I think about PLG, what I first look for is, does this business have LTV to CAC performance that's outstanding? Because if this business is telling me it's a PLG focused business, but its LTV to CAC is lower than some other business in its space that has a sales motion where they're paying a lot of commission and marketing dollars and so on and so forth, something's just not adding up. Like, why would you do this kind of deferred R&D investment to create product-led growth when in your metrics your business is actually a lot less efficient, just from a pure sales apples to apples standpoint, than some other business that doesn't have to pay for the R&D, is just paying for sales. So what you're looking for fundamentally, before you even know that they're leveraging PLG, is, gosh, LTV to CAC for this business is surprisingly high. And then you click into that and you're like, it's surprisingly high because with a smaller sales force, they can do the same amount of damage that a business in the space with a larger sales force can do, because they're getting some of that sales motion and some of that sales leverage from product-led growth. That's what you're looking for first and foremost. You don't need to know anything about the underpinnings of the PLG kind of strategy. You're just like, gosh, this business is surprisingly efficient. And then what we like to do is, if there's going to be ongoing PLG spin, we treat it the exact same way that we treat brand marketing. So this is like a fixed cost that's kind of burning in the background in order to generate sales and marketing leverage. And so what we do actually is we have a few different models that do this, but we look at the R&D line and we try to pull out, like, all right, what percentage of R&D should we bake into CAC? We actually bake it into like a long-standing kind of CAC calculation. And is LTV to CAC efficient inclusive of that? Or concepts like magic number, like, does this business have a good magic number if in the denominator you're not just putting sales and marketing costs, but you're putting sales, marketing, and some of R&D for product-led growth? And if the answer to that question, that more rigorous question, is yes, like it benchmarks really well, then you found an incredible business to back.
Very interesting. Kyle?
I mean, I look at things, as Blair mentioned, from more of the bottom up, more from the operator perspective. And from my vantage point, it's all about what happens in your cohorts. And so how many user signups are you generating every month? And where are they coming from? Are they coming from low-cost organic channels? And are they increasing month over month at hopefully an accelerating rate? And then what are those folks doing when they sign up? So the sign up might take a long time before it actually translates into real revenue. It might be 2 to 3 months on average in terms of time to convert. And that's an initial conversion. So in a land expand motion, might not be for a year or multiple years before you really see how much that new user sign up is going to spend. So you have to start looking for leading indicators. So you look for leading indicators that actually happen, of activity that happens in the product, as opposed to activities that you can measure through, for instance, your sales team's interactions. So for, if you get 1,000 signups from new users, what percentage of them reach different milestones in the product that indicate that they've seen real value and that they've reached a point of stickiness, so that they've done things like invite other users, in Calendly's case, actually scheduled their first meeting with Calendly or scheduled multiple meetings with Calendly. And those are indicators that really show that this account is going to generate LTV in the future. You just need to wait a little bit for that to play out. But at least from an investor perspective, if you're generating more and more signups, those signups see value in the product, and you believe in the correlation between those leading indicators and future outcomes, you can start to back a business based on potential much earlier than you can see that potential translate into real revenue.
I want to just add to this that you can also be rigorous in this calculation. So I think like what we're all laughing at a little bit is like, in 2021, growth for growth's sake, there was a lot of growth that was not rigorous. It was actually burning society's resources, like lighting my grandmother's retirement account on fire, and just terrible things were happening in the economy. However, you can use these leading indicators to be rigorous. And so one of the causes of this is early that Facebook, before it was really monetizing its user base, was a good business. It had a bunch of users, but they were all free. They weren't paying anything. There was no advertising. Why did the Washington Post company invest in Facebook? Like I think it was at Series B, because they knew if you have engaged eyeballs looking at content, those things monetize at a predictable rate, a couple dollars a year, whatever it was. And so they could just multiply a couple dollars times Facebook's engaged user base and get to a number to say, all right, this is a defensible, monetizable, profitable asset, and maybe it'll do better in the future. That is rigorous investing on leading indicators. That is totally fine. That is not burning society's resources. That's actually leveraging data and consistent logic to tell your story and get credit today for something that's not in your income statement, but will be without a lot of additional risk. And that's the power, that's kind of the difference and the power between entrepreneurs who know how to leverage these kinds of PLG leading indicator metrics in their storytelling. They will access capital today for something that will show up in their income statement in the future, but not by glossing over the rigor. They're applying just as much rigor. They're just helping the investor make that logical case. And if you don't do that, the investor's not going to make the logical case on their own. So it's really important to bring this rigor to bear and draw these analogies to get credit for what you've already done up front, even if it's not an income statement yet.
All right,
Yeah,
Rob, your top down and your bottom up. What's your view?
Yeah, no, this is great. I mean, look, I think what Kyle said about cohorts can't be overemphasized. When I talk to an entrepreneur and they start talking about average X or average Y, I know we have a massive problem because the average of 1 in 100 doesn't tell me anything, right, about the business. And so, we're very, very focused on helping companies think about and measure things in cohorts in particular, and how do those cohorts generate revenue over time? I think that's another piece that, companies tend to struggle with. I got somebody to sign up in January. How much money did I make from them month over month over time? And it gives me a picture that I wouldn't otherwise have. So I think, that piece of the puzzle is really important. The other thing I think that we're taking for granted here is that all companies have all this data. And it doesn't matter what size or what industry, every company struggles at some point with data and getting to a place where they finally tune the machine so that they know, what every cohort looks like or every user looks like or every interaction looks like. I think, we're moving towards a place where that's table stakes. We've been talking about for 20 years. I can't remember a time where we haven't talked about getting to one-to-one marketing or one-to-one data. But it just never happened. So from my perspective, both the top-down approach, which is what are we trying to accomplish as a business, and then the bottom-up approach, which is I need to look at my users in individual cohorts that I can segment in an appropriate way in order to tell a story for investors, but also just to run my company better. I think that that's a piece of the puzzle that's been missing in the growth at all costs mentality, which is I'm growing, who cares? Well, you're not necessarily the reason you're growing. You could just be spending money inefficiently. It could be, like I said, burning cash just to, burn cash. Maybe you'll never make it back. And so I think from our seat, it's, getting to a place where we are measuring the appropriate things and defining what those things are, which is going to be different company to company. And then providing the executive team with the resources to find that yield. And ultimately, that's what it comes down to. We're not measuring for data's sake. We're measuring it to figure out how to make more money from our customers, or make any money from our customers in some cases, which can change the entire business.
Yeah, I think that's really well put, and it dovetails nicely with a question we have from the audience. This stuff is really hard to measure. New features change the funnel and make it hard to apples to apples different product efforts. Any tips for how to set up the right data and analytics stack? So, we're talking about leading indicators. How do you know if you've got the relevant leading indicators? This is for everybody.
Well, if you're using Google Analytics, then it's wrong, and you're gonna not have any idea what's happening. So let's start there. We stopped doing GA audits like 4 years ago because they're like, well, GA says this, and all the systems you can audit say this, and they're different. I don't know. I can talk about the stack all day. Do you guys have anything you want to add, or
give the major pillars?
Yeah. So Yeah, the pillars, and they can be interchangeable to some extent. I mean, a few years ago we had CDP, and now everything's a CDP. But let's just assume we want to track we want to identify users and track events in some way. Typically, that's a customer data platform like a Segment or an mParticle or a RudderStack. And then on top of that, particularly for PLG, we would leverage something like Amplitude or Mixpanel or Kissmetrics Pendo Heap. In order to be able to build those funnels easily and audit the data. And for us, it's all about data auditability, because we want to know that 1 + 1 = 2. And that's looking at just what are my users doing. Obviously you can layer in a lot of things. Email's the greatest thing ever still. If you don't have a way to behaviorally target your user base at the right time on the right platform with messaging, then that's a huge part of PLG, in my opinion. And being able to do that using a CDP allows you to do an implementation once and then leverage it across lots and lots of tools. And then on the back end, we're seeing this trend towards warehouse first. So get the data down into the warehouse. We have the data in a lot of different places, particularly if you do have a half PLG, half sales motion where you have Salesforce, and then you reverse ETL that data up into these systems. And so, most of the time, the reason that people have trouble measuring things is just because it wasn't planned out in advance in a way that allowed them to do that measurement. You should be able to look at users in the appropriate cohorts or with the appropriate behavioral characteristics and compare them in a way that tells that story.
I want to add a very simplified kind of overlay to this, because you're talking about how to build an operational system, and
yeah, go for it.
That's sort of what
in the weeds.
That's what you get to, and you should get to very quickly in your business. But it shouldn't be a prerequisite as an entrepreneur to think about your business in a clear way.
That's right.
That you have all of these tools. And so one of the things I think about with my own business, like chalk it up to a mistake of being a first-time entrepreneur, I guess, or when I started my business, was I really wish I had just made a spreadsheet on day one. And that spreadsheet had a column that was like customer's name. And then every column to the right of that were events I thought were important. All right, customer signed up for website, customer signed a contract with us, customer paid us money again. Those were all just new columns. And I sometimes think, had I built my business in this way on a single spreadsheet with me manually typing things in back in the early days when we had just one customer, we would have had the clarity to think through the business and set it up in a way where I could have taken it to Ryan and been like, this is how we think about the business. And he'd be like, okay, to scale and operationalize, you need these systems plugged in these places. Because if you go to Ryan and you're just like, I have a business and I haven't really thought that hard about it, he'll untangle it for you. He'll figure it out. But you as an entrepreneur, like, a lot about your business and your patterns and how you should think about things. And you're sort of robbing Ryan of the opportunity to see that kind of thinking if you're just like reactively solve the problem that I've created for you. It's a mess.
Well, we have to pull on the thread, right?
You have to pull on the thread. But you pull on the thread without necessarily the entrepreneur having a clear picture. I wish more people would just like make that spreadsheet, manually fill it in customer by customer, and then go to Ryan as soon as that manual data entry effort is too onerous. And that's kind of like how I think companies should start and migrate toward tracking data in a systematic way. And I've noticed as an investor in a lot of businesses, like businesses rarely do. They just do a bunch of activities and they get to some state where they're like, hopefully there's somebody like Ryan who can fix it for me. And I think entrepreneurs would be a lot better, a lot more effective, a lot more focused if you just thought about your company data starting in a spreadsheet.
So I have a different perspective here, like to the question, I guess. So the question was, hey, if I'm changing features in the product and changing my product, how can I trust this information I'm getting in the product? How do I actually know what's happening in the user journey and understand these leading indicators of my product-led growth motion working well? The big thing for that specific question is that you first need to just have a product analytics tool like an Amplitude or a Mixpanel in place to collect events and timestamp them around your user cohorts. And then in terms of the specific milestones that you measure, like I think the basic ones are going to be straightforward and aren't going to change that much as you build more features. And so a simple one is, did they complete the sign up process and actually like verify their email? did they return to the product a second time? Normally in a PLG funnel, about 40 to 60% of users who sign up never come back even once. And so right there, if someone does, you know they're a lot more likely to convert than if they don't return. And that's independent of whether they adopt this really advanced new feature that you're building. And so I think you can keep your view of the product funnel pretty simple and straightforward initially, knowing that you can go a lot deeper over time, but the reality is that the vast majority of new users aren't going to get there.
Yeah, that makes a lot of sense. This is a question we got that refers to a comment that I think Blair made, that baking R&D into CAC makes sense as a general way to measure efficiency, but is there a way to use data to dig into the efficiency of the R&D itself?
Oh, the efficiency of the R&D itself. I mean, there's a couple different ways to take that question. I think like measuring the efficiency of R&D is really difficult. There's no like state-of-the-art method. There's nothing like LTV to CAC for R&D. Just doesn't exist. I've looked for it, read as many papers as I can find on this. My COO, when he joined the company, we looked at like, hey, can we instrument the R&D work using best practices and metrics? And the answer is like, no, there are honest to God, no best practices and metrics. So the way I think about this as an investor is I like to measure efficacy of a business in cohorted LTV to CAC. So that sounds really complicated, but let me break it down. First, a cohort. A cohort is just a group of customers. They can be cohorted by different things. They can all come from the same zip code. They can all have registered for your website in the same month. Any group of customers that you create based off of some series of events that they did is a cohort. And so what I like to do is I like to look at cohorts. Usually I'll do monthly cohorts, like the month that they signed up for, let's say Hum. And then I look at the revenue that those customers as a group create over time relative to the sales and marketing spend I think I spent to acquire them in the first place. And you create a bunch of curves, and they kind of look like up and to the right, and then they asymptote basically eventually. And you can get a bunch of these curves together on a graph. And if you see them all moving up and to the right, so you've got some like flat lines, by the x-axis, and then you start having all these really vertical lines that are higher up on the graph, that's a good sign. You're making your business more efficient. You're getting more revenue, or technically you should use gross margin. So I'm just going to say gross margin, more gross margin per unit of sales and marketing spend. That's moving up in the graph. And then you're getting more retentive behavior, which is the line having a steeper curve. And so if I make my cohorts into cohorts of people who came to my business after I did some R&D initiative, and I think that R&D initiative is now active, it's a product feature, it should be paying off, and I see those cohorted curves getting better, then I would be seeing some evidence that R&D moved the needle on my business, but I would still be measuring that from an LTV to CAC standpoint as my metric. I don't even bother trying to come up with some R&D metric. And I think if you look at businesses like Apple would be a great example, and you really think hard about how would I measure the impact of the iPhone on Apple? You can't measure it at all while they're building it. Then they release it. And two things happen. Revenue grows faster and sales and marketing gets more efficient. And so I just like to measure the impact of R&D by measuring the impact on really cohorted LTV to CAC. And I think that works pretty well for just about every business.
Very interesting. We've talked a little bit about efficiency, and I want to extend that to the idea of capital efficiency. People talk about product-led growth companies as being particularly capital efficient. First of all, is that true? And second of all, or maybe these questions are reversed, what does that mean to be capital efficient? And is that a generalizable truth for product-led growth companies? This can go to anybody.
Well, I can start off here. I mean, when you look at a lot of the best in class PLG businesses, they have been able to scale revenue to a pretty sizable amount on a bootstrap basis or highly profitable basis. Whether that's Webflow, which bootstrapped for a while before raising a big amount of funding. Monday.com did it. Calendly did it. Zapier as well. Many of the best PLG businesses do that because the self-service funnel is so efficient that they're able to attract new customers without spending a whole lot of money. They don't need to pay sales commission for every time someone starts paying for the product, and then the product scales inside an organization once someone's adopted it. And so I tend to find that the best PLG businesses are, in fact, quite capital efficient. That's one of the reasons we like to invest in them in OpenView. But what can happen in a PLG business is that you have this core PLG motion. And then especially when you're being advised to kind of grow at all costs, get to 2x year-on-year growth, 3x, 4x, you start to pour money in different places. So you start to you build that new products that might or might not get adopted. You start to run paid marketing campaigns for to acquire leads that might actually not be as qualified as the folks who join via word of mouth. You might start to do outbound cold calling with folks. And what I tend to find is that in some PLG businesses, all of those activities don't meaningfully influence growth rates enough to really pay off. But the overall motion was so efficient to begin with that people ignore it, and they think that overall I have a pretty standard software business. But what's actually happening is it's an efficient PLG motion and a really inefficient sales-led motion. And so I think the thing that I would advise companies is to really understand the core fundamentals of your business and then measure anything incremental as truly incremental.
Got it. Let's talk about financing of PLG companies. I'm curious, Kyle and Ryan, in both cases, what do you see in a pitch deck that either gets you really excited that this is the right thing, or is like the biggest red flag, like, oh my God, they haven't thought this through, or oh my God, they're sending out a signal that they're actually failing? What are some of the things that you look at when you think about venture financing?
One of the things for me, just and maybe we tag team metrics here, but one of the things that might be not so intuitive is retention rates on a usage level. So for folks that sign up and start using the product in month 1, what percentage of them use the product month 2, month 3, month 4, month 5, and so on? In some PLG funnels, what happens is that usage really drops off, and the business actually looks more like a B2C business with high churn rates and not a whole lot of expansion. And those are, frankly, difficult to finance because you can't really have a whole lot of conviction in the ability for this business to keep scaling. Maybe they'll hit 10 or even 20 million ARR, but then they'll start to flatline. But if you see that product is really sticky, and once someone has gotten set up, they keep using the product month after month, that's a really great signal for us that there's something great here.
And Ryan, what about you?
Well, I mean, we're just in the business of measuring. I'll say, I think I'd defer Blair on this. I think from our seat, one of the things I've seen as somebody who's generating decks and also who's been out, as an entrepreneur fundraising in the past, the inconsistency in what venture, partners are looking for is often shocking. We can have one deck that speaks to one person that won't speak to the next person. So, and oftentimes, for a lot of entrepreneurs, that becomes a little bit of a, whack-a-mole. Like, oh, today I need to know, this CAC thing, and tomorrow I need to know this LTV thing. And those things are not well defined in the sense that they're normalized. So even if we go into a client and we say, are doing a workshop and we have all the executives write down the definition of LTV, at the front end of the workshop, it's always eye-opening because oftentimes there are as many definitions as there are people. And so, from our place, it's really about being attuned to, what are these questions we're trying to answer? How do we define them and put them into a normalized state so that we're all speaking the same language? And to be frank, and even even if you're out, pitching, I would argue that, make sure when you're talking about LTV, the investor understands what you're saying and what that means relative to maybe what they think it means, because those can be completely different things.
Yeah.
Yeah, just one other kind of comment there. Just from our standpoint, we don't look at LTV as a metric, and maybe that's because of some of the reasons Ryan mentioned. I think in the ideal software business, especially PLG business with great net dollar retention, LTV should be essentially limitless within an account. And so it's very artificial to be able to assume that there's a defined LTV, and that just assumes that customers aren't going to keep spending more and more over time. We instead look at net dollar retention. And so for the revenue that you're generating initially, what does that look like on a cohort basis, after 3 months, 6 months, 9 months, 12 months, and even further out if there's enough data. And so NDR is more of the metric that we look at as a proxy for LTV, knowing that folks define LTV in a lot of different ways.
I mean, to be honest, it'd be way easier if every venture firm just did what you said and posted, hey, here's what I'm going to look at. Here's the threshold you should be in. And if it looks good, give me a call, right?
Well, I think,
because they don't.
yeah, but I think that that's an opportunity for founders to be self-confident and have that self-confidence grounded in rigor. Because the reason you feel investors asking for a million different things is because you're not guiding them as an entrepreneur to the metrics that matter for your business with confidence. And when you do, what you'll find is investors get in line. They're like, okay, yeah, this person knows their business. They seem to have a rigorous approach. These metrics seem to make sense. Now I have my head wrapped around the business. You don't need to go out and service like every random metrics request for an investor just because they're asking the question. You actually have to tell the investor what matters with confidence. But it's hard to do that if you don't have the rigor yourself and using this data to operate your business.
Yeah. Blair, what about debt financing for product-led growth companies? Does it make sense? Is it a viable strategy? Is there a trade-off with raising from capital? And are these trends changing at all?
Yeah, I mean, it makes perfect sense. It's a viable strategy. I mean, we have people in the marketplace doing really interesting things. Like we've been financing a bunch of companies on the net present value of their lead funnel, like website visitors all the way down to recurring customers. Like we can just do some NPV calculations on website visitors and treat those as assets of the business because they've acquired a bunch of website visitors and finance them in a way that's very similar to how you would finance receivables or ARR. And even, doing this with very, very low cost capital. So I think that the point is you can finance pretty much anything with debt that you can make a case of being predictable and thoughtful. And that case is made in a rigorous way. You can finance almost anything with debt. The trick is, can you make a rigorous case? And so making the rigorous case means basically, you have to analyze your data. You have to show that there's some real signal. It's not all noise. And you have to be a little creative to think about how to make that case. And so I think like in PLG and really any other business, it goes back to what I was saying about the Washington Post and Facebook. Like if you can look at your business and say, hey, I have all of these assets, they're not all monetized, so they're not all in my income statement yet, but let me show you why they, in a predictable manner, migrate with time to data points in the income statement. This is what my income statement would look like 6 months from now or 12 months from now. And then you, investor, when we talk about the risk together, will decide what your own haircut is. Maybe I don't give you 100% credit for that case study. I give you 70% credit or 50% credit if you want the famous Benjamin Graham 50% margin of safety, which a lot of investors do. Still, you're going to have an income statement that looks different than your current income statement. And that is the art to accessing debt capital for PLG or really on any other kind of more speculative looking risk on the surface of your business. But it's also the art to accessing equity capital.
Any capital, exactly.
In a rigorous way. So you just have to do it. You just have to think this way and operate this way as an entrepreneur.
We are coming up against the hour. I want to close out by asking each of you, where do you see the PLG universe headed? Is it going to, kind of continue along the lines that it has been historically? Are more companies going to adopt PLG? Will we see some kind of variant or hybrid of PLG going forward? What does the landscape look like? Kyle, let's start with you.
Well, so this was the first year we run a product benchmark survey every year. We actually released data last week. This is the first year that more than half of companies had some sort of product-led motion. So it's starting to become mainstream. But I think we're starting to see a bigger gap between folks that say they're doing PLG versus those that are really succeeding with it. And the bar is a lot higher to be really rigorous with data, with your experimentation, and hone your PLG model so that it's driving the return that you're looking for. And so I think that we're going to see a focus inwards to not just introduce, a free trial, a freemium product, a self-service product, but to actually do the experimentation and data gathering necessary to make it work. I think that the bar is also going to get higher, essentially, to be considered PLG with that in mind.
What you say about people saying they're doing PLG versus actually doing it makes me think it's like artificial intelligence companies. Ryan?
If I have one more person call me that wants an ML model with a sample of 2, I'm going to lose it, right? From our seat, I think there's 2 pieces to this. PLG's hot. Companies want to do PLG. Not every company is a candidate for PLG. I think that's important. There are companies that are complicated. I mean, you're not going to buy Workday, on a free trial, right? And so I think from our perspective, it is about helping the businesses, develop the testing methodology and the data rigor so that they know what's happening. And if they're going to attempt a PLG motion, if they're not already, they understand whether it worked or didn't work. And setting them up for success.
And Blair, we'll close with you.
I agree. It's like AI and machine learning. PLG is just a tactic that is effective, and some people leverage it early and reap a lot of advantage. And then eventually it'll be like using software in your business. Even ExxonMobil, has a massive software budget now, and it'll just become table stakes. And it's one of the tools that you use. And as that evolution happens, it'll become more easily financeable because it's more easily and more readily understood. And so for entrepreneurs now, if you are not using PLG, you should, if you can come up with a pattern that works in your business and is authentic to your business. If you are using PLG, you should figure out how to finance it efficiently. And those 2 things create advantage for you now, but they won't in 20 years. That advantage will go away, and there will be some new thing that's the source of advantage. But now is a really great time to kind of.
It'll be AI.
Well, it'll always be AI.
Yeah. Well, gentlemen, thank you so much for what I think is a really in-depth and enlightening discussion, and I hope that the audience learned a lot and will continue to spread the message. And we'll do it again sometime.
Thank you.
Fun. Thanks for having us.